So we're getting a lot of questions about the nature of the housing market today, and I think it's a great time to kind of revisit the market cycle and the pendulum analogy and the way that human behavior impacts this, and kind of do a little quick check on where we are right now with human behavior to try to see if we could forecast what's likely to come next. So here's that pendulum, right? And on the left-hand side, you got the seller's market. On the right-hand side, you've got the buyer's market. And you can see by the size of the S and the B, who's in charge, who's in control. And of course, in the last, bunch of years, we have not had a balanced market. We've had this we've had a decade-long seller's market almost, but it's been a super extreme seller's market during COVID, which if you asked me 16 months ago if that would be the case, I don't think that would have predicted that. But the sellers, they're the kings and queens on the throne, and the buyers are bowing and scraping and overpaying. And the nature of that market looks like this. Okay, demand is high, check. Inventory is low. We've got bidding wars. The transaction count is high. And don't let people tell you otherwise, right? There are a lot of people who have conflated low inventory with the market somehow being too tight and there's, quote, no houses for sale. There's a lot of houses for sale. They're just not on the market very long, right? And that's a big difference. People who need to understand the separation between inventory, the number of houses available at any given time, and supply, the number of houses that enter the market. The number of houses that enter the market has been pretty strong. All right, the transaction count has been high. That's why every real estate company in America is having their best years ever in 2020 and 2021. Sales prices are rising. Yep. And the question then is, when will it shift back? And when it will shift back is when the prices go up so far that the buyers resist. The buyers just finally say, no, I'm not going to do it again, right? I'm not following this up the hill any further anymore. And so that's always the thing that we're in a seller's market, when we're in a seller's market, that I always looked for, not in the data, because the data is old, right? We're sitting here in August. We're going to hear about July home sales soon, but people forget that July home sales were deals that were put in contract at the latest June, maybe May, which reflects properties that were probably put on the market in May, maybe April, which reflects buyers and sellers' attitudes from months ago, right? So the stats that come out today reflect buyer and seller behavior and attitudes 5 months ago. The buyer and seller behavior today will actually show up in the stats 5 months from now. And so this is one of the benefits of actually being in the business, because you can ask people who are engaging with buyers and sellers every day, is anything changing? And what I'm hearing, what I started hearing about a month ago, is that we still have multiple offers, but instead of 12, it's 3. That was the first early indicator that we picked up on that something was afoot, that the buyers are getting fed up, and that's where the shift of the market is going to if it's going to happen, it's going to start like that, right? Where the buyers finally say enough's enough, right? So the question then is, if the market is going to shift to a more balanced market, what does that start to look like? Okay, well, that means demand declining. It might be off a bit from the feverish pace. Like a year ago, there was fear-based buying going on. That's kind of slowed down. But a lot of people that were moving other parts of the country, a lot of people that were moving out of apartments into houses, they were going to do that anyway. They're just doing it sooner. The transaction count declining, not really seeing that yet, but that could come. Inventory increasing. 10 minutes ago, I was on a call with our sales team in Fort Worth, Texas. And a gal told me that they're seeing some inventory coming on the market from folks that were doing a wait and see approach. Sellers who are trying to time the market at the peak are now starting to sense that maybe we're getting to that peak. So that means inventory increasing. So that's starting to show up. Sellers begin to capitulate and drop their prices. That is starting to show up. Okay? And then the sales price is flattening out, or sometimes they go down, but not usually. We'll talk about that in a moment. But what's interesting about the COVID experience is that these phenomenon still follow the same patterns. They just happen faster, like the timetable. Think back to last April, right? Last April, usually the way the economy works when it's going to turn into a recession is that something happens that blows consumer confidence. The stock market usually reflects that lack of confidence first, and the stock market takes a hit. And then businesses lose confidence. They see fewer people in the stores, fewer people placing orders on the websites, business to business clients starting to slow down. And eventually those companies begin to like stop hiring, and then eventually they begin to let people go. Well, during COVID recession, like stock market crashed on Monday and unemployment tripled by like Friday of the same week. It was insane how fast it all happened. So fast, in fact, that the recovery bounced back like a V back then, and real estate, which moves a little more slowly, didn't even do anything really but freeze up for a couple of months, and then this boom kicked off. So what would normally, I would think, take time to come to pass, where buyers are getting fed up, eventually sellers get the message, the demand softens, the inventory begins to accumulate, the sellers get the message further, they start lowering their prices. That was only a month's time, and I'm already seeing those two things happening, where normally it would be 6 months. So the compressed timetable that this recent economic situation is giving us seems to be happening again here. But again, back to I don't care about the pace and duration of the cycle. It usually still follows the same human reactions to things. So these are the things that happen when the market's going to go back to more balanced. Okay. Now, for it to make its way to a buyer's market, what does that have to look like? Well, demand has to be low. We're not seeing that yet. Inventory has to be high. We're not close to that yet, right? We're just seeing a tiny little bit of an increase in inventory. Transaction count goes low because the buyers are saying, nope, I'm not going to buy. And the sellers are saying, you're going to buy. And like a standoff ensues. And as a result, the transaction count in the market declines. We're not seeing that yet. Sales prices begin to drop. And the shift to the next phase is eventually buyer demand comes back. So I don't think we're going into a buyer's market. I think we're probably going into a balanced market. And I think that's probably a really good thing. And so let's just talk real quick about long-term home prices. This is a chart of my lifetime in the housing market, right? So 1968, what I want to point out to you is that there was a very, very, very steady trajectory for better part of 40 years, right? Where when people talk about the real estate crash of 1981, it wasn't a real estate crash, not nationally. It was a flattening, okay? Back to that pendulum, right? What happens? Well, there's a standoff and the prices flatten until the buyers feel like they're getting a decent deal again, and then up it went. I hear about the real estate crash in 1990, not nationally. Local markets maybe, but nationally, all we saw was a slight flattening of that curve. Then we had the real estate boom in the 2000s that went too far, right? And if you look at this chart and you ignore what happened after, that was clearly too steep of a curve. But isn't it amazing how when the correction happened, it kind of bounced back to where it wanted to be anyway, right? And it picked up. If you follow this line and you cut across the peak and the trough, we sort of caught up right about here. But now the question is, is this too steep of a curve, right? We established over most of a decade a much steeper incline in prices. And then this last piece, this COVID part, really doesn't make sense, right? That's too steep. So the question now is, are we going to see a correction like we saw back 10 years ago, which wouldn't be a terrible thing? A lot of people have a lot of equity right now. We don't have a situation where they were buying with no money down for the most part. And so if we saw a correction in prices that brought us back to this red trend line, it's not going to be that painful, right? And if we see a flattening, which I suspect is actually going to be the case, is we're going to see a flattening for a couple of years until these crazy gains we took over the last 12 months are just kind of given back a little bit and we flatten things out. But keep in mind that the housing market long term, because of the core demand drivers, i.e. people want to live here, they want to live indoors when they live here, and more, especially now, they prefer 4 walls, 4 yards, separation from other people. The single family home is more popular. It's always been popular, but it's more popular than ever. So our confidence level is that for the balance of this year, the market's going to be very strong because we're going to see more properties come on the market and a more balanced market where sellers are going to be more realistic, but the buyer demand is going to stay very strong and in place. And what I'm hoping happens is the buyers hold their ground and we give back a little bit of these gains, or at least flatten out, so the market gets more reasonable in terms of the appreciation. So that's my analysis of the housing market. If you have any questions, especially if you don't agree with me, post something down below and we'll chat it out. Thanks for watching.